Hi, this is Stephen Ertel with Consinity Financial. Thanks for joining me today. I'll be presenting on the juiced economy, really trying to highlight U.S. macroeconomic weakness. So these areas of weakness that I'll be covering today, demographics, just slowing population growth and more of an aging population in the future, real wage declines, a fragmented jobs market, more of a part-time economy, look at household and corporate debt and also margin debt, and a declining family savings rate. I'll first look at the declining birth rate in the U.S. Currently, we're about 13 births per 1,000 population at record lows. There could be many contributing factors to this, but I like to look at declining wages, tougher jobs market, indebtedness, increased cost of living. It's just generally harder for young folks to start a family nowadays. They're waiting longer to have kids and they're having fewer kids. And that birth rate affects the age distribution of the population and economy and which is a key driver of economic growth. If we look at India on the left, a large percent of their population is young. And in turn, their economy needs to grow at about 7% per year just to keep up with those folks that are entering the workforce. The U.S., they had a similar looking picture back in the 1950s with the baby boomers, who now represent that kind of a bulge there in that 50 to 60-year-old age range. But now, after the baby boomers' kids, which is that second bulge there in the 20s to 30s age range, we see that kind of necking down, which is that slowing birth rate. Really, over time could end up looking like the negative population growth picture we have on the right with Japan, where they have a large number of old people in the country who aren't working that need to be supported by the younger generations, but with a very slow birth rate. You actually get negative population growth. You end up with fewer and fewer young folks to support that aging population. And this, could be evidenced by really struggling economic growth in Japan going back for about 25 years now. As I referenced earlier, declining real incomes likely are a contributing factor to that lower birth rate here in the U.S. The chart on the right illustrates about an 8% decline over the last 15 years in real median household income. So adjusted for inflation, this data is directly from the St. Louis Fed. It's subject to, their flavor of the week CPI calculation. I would tend to believe that, this is kind of an optimistic look at real wage declines. I would also look at this trend continuing, so downward pressure on real incomes, globalization and other economic factors playing into that. Next, I'd like to take a look at these two charts to illustrate kind of a weakening or more fragmented jobs market. First, the chart on the right, we see a huge spike in part-time workers during the Great Recession and a steady decline downward following as the labor market strengthens. However, we're pretty late in the economic cycle, and present levels of about 6 million part-time workers due to economic reasons is about 50% greater than where it was 10 years ago. And if we were to look back farther, historically, these would be peak levels in part-time workers, not necessarily a trough that we might be at now. On the chart on the left, we can look at this as it's an index. Total number of hours worked by all persons, excluding agriculture in the U.S. economy. You can look at this as kind of total man hours. Previous to 1985, we had a steadily increasing number of hours worked in the economy. However, 1999, corresponding with peak median incomes in the U.S., we've seen this kind of boom and bust cycle in total hours worked. And what I see is kind of a ceiling, in 1999, 2000, once again in 2007, and once again in 2015. It appears this could be kind of a limit of overall hours worked. Now, productivity has gone up. However, we're also working a lot more part-time jobs to secure those hours. Couple that with declining median real incomes, And I think this paints a picture of a much weaker jobs market than we would see historically. Next, let's look at the real juice of the US economy is debt. Consumer or household debt on the left, we see that deleveraging during the Great Recession, which caused a lot of economic pain in our consumption driven economy. But despite real incomes declining, we're seeing peak debt levels come back up to where they were pre recession. And also, you see the same deleveraging on corporate businesses. These are non financial, so excluding banks. We see that same deleveraging during the Great Recession. However, it's business back as usual, low interest rates really fueling corporate debt, uh, you know, a lot of which is funding share buybacks. And while we're talking about share buybacks, we might as well cover NYSE margin debt. The data for this chart came from NYSE. I didn't include a reference for them. We can see this is really debt used to speculate in the stock market. You can see the boom bust cycles. You can see that big peak there in 1999, 2000, corresponding with the dot-com bubble. Once again in 2007, corresponding with the housing boom, and now record levels of debt corresponding with record levels of the S&P 500. If we were to overlay the S&P 500, which I did not do unfortunately, we could actually see the S&P moving in lockstep with margin debt. Historically, the S&P 500 actually outpaced the growth in margin debt. However, since 2009, this is the first time where we've actually seen margin debt outpacing the growth in the S&P 500. So really, coupled with the share buybacks on behalf of corporations, we can really look at debt, inflating financial assets. And a byproduct of this kind of growth in debt, and most particular household debt, is this downward trend in the personal savings rates for households. Peaking in times of high inflation, high interest rates in the late 70s and early 80s, we've seen a persistent downward trend for the last 35 years. We have to look at a correlation with interest rates. As in the Greenspan era, we've seen lower and lower interest rates, and now, in present day zero interest rates, families are less incentivized to save, more incentivized to spend, of course, generating economic growth and corresponding growth in debt. It's hard. There's a lot of noise here. These are unadjusted figures. I'm not sure what some of these outliers might be. But I'll point out a possible uptrend over the last 10 years or so. After a bottom in 2005, 2006, we see what could appear to be an increase in savings rate. This could correspond with kind of this deleveraging that we saw during and following the Great Recession. However, with debt levels once again on the rise, median real incomes on the fall, then, is this upward trend, is it going to continue, or is this kind of more of a statistical anomaly, and just more of a persistently low personal savings rate, kind of incentivized by low prevailing interest rates? So I'll sum this up. Has the U.S. economy run out of juice? Current low interest rate environment has not produced anywhere near robust economic growth. Weakening key economic growth factors, so that slowing population growth, real wage declines, potentially over-leveraged households and businesses. And are Americans any happier because of all of this stuff? This consumption-based society that we're in. More and more stuff and the resulting debt, more technological advances, it's all great, but are people any happier because of it? And if they decide that they're not, as a consumption-based society, deleveraging will be extremely painful. As I'll reference the Great Recession, that deleveraging, caused a lot of problems for the U.S. economy. So, what are the solutions? I have no idea. Nobody knows. If anyone had the best solution, it would be in play. But I don't trust that anyone would have a solution for this issue. I think that the U.S. economy has overextended itself. We're over leveraged as a whole. We have just continued downward pressure on wages due to globalization, less competitive worldwide. Uh, I think that a potential solution would be to let deflation happen and hit the reset button, so to speak. And thanks for joining us. Once again, this is Stephen Ertel with Consinity Financial. We're a fee-only investment advisor in Spokane, Washington. Subscribe to our YouTube channel. I appreciate your feedback. Send me an email or check out our website. Like to continue putting out these educational presentations about once a month. We'll hope you join us for the next one. Thanks.